Good morning, everyone, and welcome. It's time for the April edition of the monthly economic briefing from the Kenan Institute of Private Enterprise at UNC Kenan-Flagler Business School. I'm External Affairs Associate Rob Knapp, and it's great to have you with us this morning. So this is what we do every month. We get together and we talk about the jobs and the job numbers. And we're going to do that again this morning. Our job number this morning is 236,000 added jobs to the economy. So we will get to that, but we're going to have a little value added this morning. Last month when we were doing our briefing, just as we were doing it, the news was breaking about Silicon Valley Bank. And we weren't able to say much at that point. We have much more that we can say now after a couple of bank collapses last month. So our chief economist, Gerald Cohen, is going to be with us momentarily to talk about both of those things. But first, let me tell you a little bit about the ground rules, just in case you haven't been with us before. Gerald will be with us for the first 15 minutes to give his analysis of both the job situation and the banking situation. After that, the show goes to you. You are going to send us your questions, and Gerald will answer them. So if you have questions, you don't have to wait for the second half of the show. You can give them to us now. Please use the Q&A function at the bottom of the screen to send us your questions, and we'll be happy to try to answer them. If you are a member of the working press, we try to prioritize your questions. So please give us your title and your organization when you submit your questions. If you're joining us by phone today, you can get in on the fun. You can email me your questions at rob_knapp@kenan-flagler.unc.edu. We will try to get to all of the questions that we can inside of our 30 minutes. Sometimes we leak over a little because we like to answer them all. We'll do our best either way. So I think that's everything you need to know. So let me introduce our chief economist, Gerald Cohen, who is going to give us his analysis of what's going on this morning. Howdy, Gerald. Good to see you this morning.
Good to see you on this Good Friday, Passover Friday. Good to be here exploring the employment report. So as the kind of headline slide that you are seeing illustrated, we had another strong month on the headline. The details were a bit more mixed, but we're starting to see some trends showing in terms of areas of continued strength versus area of weakness. We are seeing, well, kind of seeing the impact of the Silicon Valley Bank on the financial sector, potentially on the tech sector. Well, we're kind of seeing it, and you'll hear why I'm saying kind of. But the headline number was quite strong, 236,000. The revisions were relatively small, a small negative revision in February, a positive one in, I'm sorry, a small positive one in February, a negative one in January. Kind of net, we're down a little bit versus kind of the overall expectations. Hourly earnings rose, which is good for workers, although as I'll discuss shortly, it's not keeping up with inflation. Or at least the year-on-year is not keeping up with inflation. And the unemployment rate ticked down, and that's despite the labor force increasing, which is kind of good news. So when the unemployment rate can go up or down because of two factors: the number of unemployed changes or the denominator changes, which is the labor force. And so if there's a big gain in the labor force, the unemployment rate could actually go up. In this case, we had a big gain in the labor force, which is good news, and the unemployment rate ticked down. So those are kind of positives. But I should note, I wish I were telling you all good news, but we've been, as I've discussed in the past, as Greg discussed last month, my favorite economic indicator is the spread between 10-year treasuries and 3-month treasuries. It turned negative at the end of last year. We had not been saying a recession until then. Now, and we started saying a recession when a lot of people were starting to say the opposite. People were talking about no landing. And now something has broken, as in SVB and Signature Bank, and cracks in the financial system, and that supports our hard landing view. That said, we are not, we don't think the recession is going to be deep. We just believe that we are going to have a fairly mild recession, but we are headed for a recession. And this is exactly kind of what you would expect, what the yield curve is telling us, that the Fed has raised rates substantially. That causes hardships for banks, which then feeds through for higher interest rates and weaker lending, tighter lending standards, less lending. And as a result, and then consumers stop borrowing because of higher interest rates, and then even more pressure from stress in the banking system. And that all means that that we'll ultimately end in a recession, we think, in the latter half of this year, early next year. So we don't think we're there now. And the data supports that. You don't get 236,000 jobs in a month when you have recessions. And as I wrote in a piece last month, this job number tells you something about next job number. So which says a strong job growth is telling us that the probability of continued okay job growth or positive job growth next month is likely to be very high. So this chart illustrates, again, a strong number, some slowing. Just to put this into perspective, and unfortunately COVID makes it difficult to show this to you, but 236,000 jobs is a really strong number relative to our demographics. And so what we're doing is we're making up from the COVID period. We're now well above the peak that we saw in COVID, but you could say relative to where we should be if we had just gone on with that trend. And I'm not sure that that's not the right calculation. We're still below that trend, and this is why you could say that we're still creating these jobs. As this chart illustrates, the mix is changing. So these are 3-month averages, not the month-to-month changes. I'll show you some of the key highlights of those month-to-month changes. But you're seeing, I've kind of chosen at the bottom areas that we're watching carefully. Finance, which on the month, as you'll see, was actually up, but the 3-month average was down 2,000. Tech, also on the month up, 3-month average down 3,000. Temp help down on the month, but on the 3-month average up. But all of these, or generally, are illustrating signs of a slowdown, or at least in finance and tech, manufacturing, construction. 3-month average, there's just month-to-month volatility that you want to be conscious of. So it's good to look at, not to take too much stock in 1 month's number, and to look at the 3-month average. One of my favorite indicators I've talked about before is temp help. And this kind of illustrates the challenge of looking at 3-month versus month-to-month. This graph illustrates that it is a good leading indicator. If you think about the intuition, the firms, when they're not sure about a position, they'll hire a temp, and then they tend to shed those temps first when things turn down. So the fact that temp help, you can see how it tends to be kind of lead before you see a recession, which are the gray bars. And so you can see we've been on a generalized downtrend, although the last kind of few months have been some squiggles around, with the latest month down, but the previous month's up, up. Another key measure that we talked about before is tech employment. This might be surprising given what's happened in the tech world, and given SVB. We saw 2 negative months, and now we saw a positive month. By the way, this number you can't find in the BLS report. We've stitched together. Tech has a number of different places. There's software, there's hardware, and all of those are separate jobs which we've stitched together. One of the things I should note, though, about SVB is that this employment report reflects a survey that was taken the 12th of the month. And so SVB occurred in the week at the very end of the week of the 10th. which was when the last employment report came out. The end of March, the week of kind of March 10th, and then Friday was the 10th, and so really got going in that week of the 12th, and that's but you'd only see 1 week's worth of data because it's a survey. Even though it says it's the March employment report, it's really a survey of 1 week in kind of the middle of March. So you saw a rise in tech, and surprisingly, you saw a rise in the finance sector. This does not include real estate. Many people, when they talk about finance, include real estate. I'm just trying to separate it out to get a better measure of kind of the finance world. So rising interest rates have taken a toll, but as I mentioned, the timing of this report means we may not be seeing the full extent of the employment, of the challenges in the financial sector. And I'll get to one high frequency illustration of those challenges. Offsetting the generalized weakness in tech and in banking are leisure and hospitality, where there was I think a 72,000 gain and in jobs, and we're now only 368,000 from the February peak. This has been a significant laggard. Overall employment is well above its peak, as I mentioned before. Finance above its peak, business services above its peak. So this is a combination of change, difficulty finding workers in this sector, but also kind of changes, or at least until recently, more recently, people not going back to restaurants, or at least until, and so this is an area we're now closing in on our previous peak, and this is where we're seeing strength. This, and as I mentioned mentioned the text, education and health. So those are the two areas that are offsetting the weakness that we're seeing in other places. I mentioned before, average hourly earnings up 0.3%, which are the blue bars. Year on year, which is the red line, is up 4.2%. You're seeing some slowing in that. It's interesting because the labor market's still quite tight, but it looks like you're seeing some slowing, which means maybe there is some weakness showing up in people's bargaining ability to bargain for higher wages. The Fed will look at this as a positive because you're not seeing this wage push inflation that they've been worried about. But it's notable that inflation adjusted earnings are roughly zero. So if you take the 4.2% year-on-year change in wage growth and you compare it to 4.5% inflation, you're basically still negative. So workers are having a hard time kind of making ends meet, which again pushes on the recession because they'll slow their spending, as we saw in the month of February. Another measure that we look at carefully are the number of hours that are worked. And you've kind of seen this gap where hours worked were growing more slowly or more quickly than GDP. Hours worked in blue, GDP growth in orange. And that basically means that productivity, so more hours were worked, GDP was growing more slowly or even negative in last year. That means that productivity was negative. If there's no change in productivity, the strength in hours in Q2 suggests that should be Q1, suggest 2.5% GDP growth. And lastly, some good news. The labor force seems to be coming back. Prime age, which is 25 to 54-year-old labor force participation, ticked up, I believe, or at least was I think it ticked up actually, and it's now at pre-COVID levels, or may have stayed the same relative to last month, which is at the pre-COVID level. What's notable is where you see the overall number, it also rose, but it's been on this decline. Much of that is just demographics. We just have more older people, but you also see the 55 and plus year olds having that labor force participation has not come back up. And that relates to retirement choices. So there's kind of demographics and retirement choices weighing on the overall, but good news on the kind of prime age workers. We could talk about the challenges that these demographic forces create during the Q&A if you'd like. Turning to kind of forward-looking measures, just want to show that job openings did decline. This is in their lagged month, so we're looking at the February data, but they still remain very high, very strong relative to history. What I've been saying is we have a recessionary decline. We'll be back at kind of pre-COVID levels, which are still very high relative to history. So lots of job openings, lots of people, demand for workers. Firms can't find workers despite the slowing activity. Another measure that we look at closely, weekly jobless claims. Yes, there's a bit of a tick up in this, but these levels are very, very low, suggesting continued expansion. But this is something that is worth watching, whether this trend will rise. We ultimately think it will, because we think, as I said, higher interest rates, banking challenges because to the consumer is going to weigh on the economy, and thus a recession, and you're going to see layoffs, which is reflected in these job numbers. And lastly, and I just want to point out, this is the best measure that we have that there is stress in the banking system and its impact. Commercial and industrial loans, which are loans to businesses, fell 1.1% in the week ending March 22nd. This is there's weekly data on loan growth. And I'm sorry, if I wanted to, there is a lot of week-to-week noise, and so we want to see what's going to happen in the next week. That data will actually be released tonight. But this data, this downward tick right here, is suggestive exactly, when you would expect it, that the banking system is pulling in its horns and kind of starting to see it's the earliest consequence we can really see of the Silicon Valley Bank, Signature Bank stresses in the banking system. So let me stop there, open it up to Q&A.
All right, thanks very much, Gerald. That is a lot of information in a short amount of time that you gathered in an even shorter amount of time this morning before we came on. So
thanks.
Very, very impressive. So let me go ahead and get to the questions, because we do have a few. I've got a couple of my own, but I'll take my place at the end of the line and see how we do here. Let's see, from our friend Daniel Barkin at Business North Carolina. He was looking at your favorite economic indicator, the 10-3 spread. He said it's more negative now than I can find since December 99. He didn't, I don't know if he had the data before 99. It looks like it hasn't been lower than it is now since the early 80s. Is that correct? Does that sound right?
That is correct. That is correct. If I could share my screen and show you that, but yes, during the early 80s, when the Fed really kind of clamped down on inflation, we had a period of high inflation in the 1970s. Paul Volcker, I think it was called the October surprise, when he just said, like, look, we need to do this to bring out inflation expectations. And so, yes, the Fed raised rates a lot, and the yield curve was the most inverted I think we've seen in history during that period, that early 80 period. There's also a period in the mid 1970s when you saw a curve that's this inverted. The level of the curve, I think, is informative, but I don't want to read too much into it. I really think of it in some respects as a 1-0 variable, although it does go into some of our models. So I'm talking out of both sides of our mouth. But I think it is showing, that we're having a recession. I think there are other factors that lead me to believe, and I talked about it before, the strength of consumers' balance sheets, $2 trillion of excess savings that households have, which will keep the economy, keep the recession relatively mild.
Okay, thank you. Triangle Business Journal, Lauren Onesorge says, can you dig deeper into the construction industry numbers and how we should look at the labor shortage in that industry in terms of impact on the greater economy?
That's a good question. Just to kind of give you a perspective on this, I actually had a chart which I could show of the monthly construction numbers. But I won't bother. I'll just say that in the month, construction was down 9,000. It's kind of been rumbling around up and down around zero. And I think the challenge is and interestingly, last week I had coffee with some construction folks in the Triangle, and I asked them about labor shortages. They said that they're managing okay. I think they're more concerned about higher interest rates, but they said that they're a kind of a high quality employer, quality employer. So they're seen as a good place to work. So they did not have the challenges that others are having. I think there's a kind of a big yin and yang in construction. So higher interest rates weighing on the sector, which is slowing but you do have labor shortages in the sector. I need to look more carefully, and I can kind of get back to you on I do have the data. I just haven't looked at it this morning on residential versus non-residential, so versus commercial, and I think there definitely is differences that are going on there. So the commercial market is much slower. People are hesitant to move back. Their work in the hybrid work environment. Not a lot of demand for new commercial space. Although there are sectors that are newer buildings, wet labs, which are occurring in the Triangle region, and stuff where you need to be in person. But residential is quite strong. But again, that's where interest rates weigh. So I need to look more into the data to say, and I think it could be very much regional. And this housing has always been a regional area. So think the Triangle, where we continue to have strong immigration, continue to have strong firms moving here, people moving here. That means that you're going to need more housing, and you've seen that in looking at the prices that prices have leveled off, some small declines, but not big declines. While in other places, you're seeing much bigger declines, much more weakness in the sector in construction.
Okay, a lot going on there.
Yes.
As there is just about everything we talk about. Let's see. Kim Cockrell asked, do you feel that we will continue to see bank failures in the near future?
That feel is a good way of putting it. I think anybody making a prediction about a financial crisis run the other way. I am cautiously optimistic because of the policies put in place by the government, by the Fed, that they are trying to staunch this. I think one of the things the reason why they kind of guaranteed deposits is because, all deposits is to avoid bank runs, and that's really what generally avoids financial crises. And given the general strength of balance sheets in the United States, and this goes back to why I think the recession is mild, there shouldn't be that much of this channel where there's a lot of debt. The debt, people are underwater and they're on their debt. That causes them to stop paying their loans. That causes the banks to fail. I think what this is really about is, as Silicon Valley Bank is, rises in interest rates and not good risk management cause them to have losses, not because of people stop paying their loans. It's more the price effect, and then you had the bank run where people pulling out their money. And so by guaranteeing deposits unlimited in some cases, that should staunch it. There's a bigger challenge because, how do you put that genie back in the bottle? And that's a question that we've been asking ourselves, and I get asked a lot. can the federal government go back and say, oh, we're not guaranteeing all deposits, which is kind of what they're doing. And that's one of the challenges that you're seeing people moving away from smaller banks where they say, well, you're not systemically important, so I'm not going to, the Fed may, or the Treasury may not guarantee my deposits. It's really the Treasury and the FDIC. So I'm going to move my money to a bigger bank, and that could cause, challenges in smaller banks. And it's interesting, you're seeing this in even the super regionals, which are super large, systemically important banks, but people are just saying, well, it's not as big as JP Morgan. And so that's a challenge that's occurring. So I'm cautiously optimistic, but only time will tell. And, reminded that we said the same thing after Lehman Brothers after Bear Stearns in March of 2008, and then things looked like they had calmed, and then September of 2008, things, Lehman and the global financial crisis occurred. I think, as I said, the underlying debt dynamics were a lot worse then. Household savings dynamics were not as strong then. So that's why I'm optimistic, but it's hard to predict. Or as I said, you can't predict it.
Yes, it comes with a caveat.
Economists always come with a caveat.
Right. It's a standing headline. Let's see. Looks like we've got time for a couple more. This one is from Barbara Senich. Barbara, thanks for being with us again this morning. State and federal government jobs are necessary, of course, in our society. However, they're funded by taxpayer spending rather than independent economic activity. How do you think about the trends in government employment from a long-term economic perspective?
So I think this is a question about what goods and services the government should be supplying versus what it shouldn't be supplying, and that's a question that I think there are very strong political perspectives. I'm not going to weigh in on that. What I will say is when I talk about the healthcare and the education numbers, those are private sector numbers, but there's a public sector component, because when an elderly person who's on Medicare goes to a private hospital, it's the government that's paying for that. That's not a government job necessarily, other than the person that's administering Medicare, but that is government services being provided, or government paying for services that are provided in the private sector. And one of the reasons why you could say people are generally optimistic about jobs in the healthcare system is that very the demographics, where I was talking about labor force participation. The flip side is that's meaning a big increase in healthcare spending. Again, that doesn't necessarily translate into that many more government jobs unless it's being provided by the VA or a county-run hospital, or in the case of UNC, the UNC University Hospital, where we're state government employees. So it becomes a little bit more complicated. There's this other question about what goods and services or that the government should be supplying directly. And one thing I should note is every budget, whether it's a Democratic government or it's a Republican government, has that set of services shrinking relative to the size of the economy. So what's known as kind of discretionary spending in every budget is declining. That basically what these budgets are saying is that the government becomes a relatively smaller share of the economy, while government spending is rising because the spending on things like Social Security and Medicare and Medicaid are a rising share. So it's there is, again, as I kind of used a yin and a yang, there's this complication of whether the government is supplying the service directly or whether the government is paying for the service.
It's a yin-yang morning here on the economic
Yes, exactly.
briefing. All right, we're going to give last call today to Robin Terriano, who asks your interest rate predictions, now taking into consideration SVP, and banking system pulling back its horns?
Again, I wish I knew the answer. So my crystal ball, I don't have a crystal ball, and the crystal ball is very cloudy. I will say I was a bit surprised that the Fed continued to raise rates last month. They was really on the fence. And I think what they were maybe showing is that the inflation challenges, and I didn't show it in this chart, continue. And that's the problem. I think it's very much dependent. So the inflation remains stubbornly high. Some people are showing, oh, certain ways, if you cut the data certain ways, it looks like it's declining. By my measure, the measures we look at, core inflation, you'll make sure that chart gets included in the pack that we send out. It's barely showing any declines, very, very high. And that puts pressure on the Fed. And going back to Dan Barkin's question, because they've lost some credibility from what Paul Volcker did by clamping down, saying we're fighting inflation, we're never going to let this genie out of the bottle. Well, they made a mistake last year and let some inflation genie out of the bottle, and so they're fighting for credibility. So if there weren't if we hadn't seen any cracks, I would say they are going to have to keep going. I think the more cracks we see, the more that the less they're likely to continue raising rates. This data, it's strong enough that I think they actually will raise rates, assuming we don't see any pressure in the banking system. But they also have better data into what's going on in the banking system than I do. So I'm going to say provisionally that we haven't seen the last rate hike, but there's a bit of dynamism in that. The more people that say that, maybe the more pressure on banks, then the less likely that's to occur. And I think it's really like what's going on internally. Is the banking system, is the banking system generally strong? I generally believe that's the case, which is why I'm saying higher interest rates, given this report, given the inflation report. But it's a close call, and I think we're close to the end.
Okay, thank you very much, Gerald, for bringing some clarity to what is always a complicated picture here on a Friday morning. Appreciate the answers, appreciate the questions as well. Thanks to everybody who joined us this morning. You brought the questions as always, and we do appreciate that. So with that, let me tell you that for those of you in the press, we'd love to continue the conversation. If you'd like to talk to Dr. Cohen or any of our other experts about anything that we research and talk about, please let me know and I can arrange that. I'm at rob_knapp@kenan-flagler.unc.edu. For everybody watching us today, we hope that you'll visit our website at kenaninstitute.unc.edu. You can get an idea of our full range of research there. A couple of things to look for: our grand challenge this year, Workforce Disrupted, which is a fascinating look and includes research and commentary from Dr. Cohen and our other experts. You'll also want to look for the American Growth Project, our look at the microeconomies throughout the United States that make up the big economic numbers. We'll have another report coming out soon on that, but you have a little time to catch up if you haven't read the others, so you might want to jump in and do that. We are done for this morning. We'll be back here again on May the 5th, Friday, May the 5th, when the next set of job numbers comes out. We hope you'll be with us then. But for now, thank you for being here today and have a great Friday.